Okay, reverse mortgages have a reputation. Some of it is earned. A lot of misconceptions about reverse mortgages are outdated or just wrong. So let's cover that. Hi, I'm Tara. I am a mortgage broker in Utah, and I want to help my homebuyers understand the basics of reverse mortgages. So I'm going to cover some myths. I also want to touch on the history of reverse mortgages a little bit. So the first mortgage was actually originated in 1961 in Maine by a private bank called Deering Savings and Loan. They wanted to help a widow remain in her home. That's really the origin of the reverse mortgage. So it's been in private banking, kind of like a proprietary niche product since the early 60s. In 1988, the Department of Housing and Urban Development created the official HECM product. So that is called a home equity conversion mortgage, which is the official name of a reverse. 10 years, that became a pilot program. FHA, Fannie, Freddie, they all run kind of test loans occasionally. So in 1998, the HECM program became permanent and was no longer a pilot program. Also during these years, just it changed a lot. Protections were added. In 2009, HECM, or reverse for purchase, was introduced, which we'll talk about in another video. But basically, prior to that, it was for existing homeowners only, for refinances only. So they created a loan program that allowed people to do a reverse purchase. And then in 2013, HUD implemented major policy changes that improved the program, reduced borrower risk, really added a lot of protections for borrowers. So a lot of the myths you've heard about a reverse mortgage were from loans done pre-2013. So number one myth is the bank wants your house or they're going to take your home. That is not true. It's a loan just like any other traditional mortgage. The bank or the lender will put a lien on your title just like your regular traditional mortgage does. What the lien does is it does protect the interest of the bank in the home as its lender. So when you go to sell or if the home is foreclosed on, they are a lien holder and they get paid back. Myth number two, they can kick you out whenever they want. That is not true. Reverse mortgages are called a non-recourse loan, meaning they can't just foreclose on you for no reason. If you live there as your primary residence, pay your taxes, insurance, HOA, maintain the property, those are the requirements of the loan and to stay in the loan. So if you cannot pay your taxes or insurance or no longer occupy it as your primary residence, they can start the foreclosure process. So there is a way they can foreclose you on you. I don't want to make it sound like they never can, but it's pretty simple to maintain ownership of the home. So the kids or your estate inherit the debt of the loan. That's not true. Part of the changes made over the years with the FHA insured program is that insurance comes into play if you're upside down in the home, the balance is worth more than the home is worth. That mortgage insurance comes in and covers that. So say you are in a position where you're upside down in the home, as long as you still meet those requirements I talked about in the previous myth, you can stay there as long as you want. The bank is never going to come back after you as long as you meet those requirements, no matter what the balance of the loan is. But once you pass away, your family has to deal with the home just like they would any other home. So the FHA the mortgage insurance that you pay on the loan will kick in. It protects your family from that. If there's no equity in the home, they can keep the home for 95% of the current value of the home if they want to take on and do a new loan, refinance it into their name or sell it. Or if that's not really worth it, you can totally just walk away and let the bank deal with it. But the bank is not going to come after your estate for the difference. Only desperate or poor people do this. That is not true. While it does benefit people who maybe are kind of asset rich and income, poor, it's a great option for those people. It is also a great option just for people who want more flexibility in their retirement. There's a lot of cool things you can do with it. Because it's a loan, it typically, I will say, always check with your CPA, but it typically does not impact your Social Security benefits, those kind of things. So a lot of people like to use this as just another tool in their toolbox in retirement. So is it for everybody? Absolutely not. Is it a bad loan? Absolutely not. And myth number 5, you can outlive the loan. That we kind of covered this, but again, they don't care how long you live. You could live to be 150 and your house, the balance on your loan could be 3 times what it's worth. As long as you meet the other requirements that we talked about, that you could stay in the home as long as you live. So it doesn't expire, there's no time limit, there's no term, any of those things. It's all about those other requirements that you meet. To sum up, if you watched my first video about these, again, just like any loan product, a reverse mortgage I don't look at any loan as good or bad. It's whether it's a fit for your plans or not. And a reverse mortgage, we got to kind of look at a bigger picture because it does impact your future and your estate, long-term plans for your estate and all those kind of things. But if you want to be in your home and it's getting a little too expensive, or you need to do some things to help with tax planning, these are great options to look at. So drop your questions below if you've heard any sketchy reverse mortgage stories. Let's talk about them. Put them in the comments and we will chat about it. Thanks.